there's very few things that I can say for certain. One of them is that digitization is coming for everything. I just don't know when. Here's another version of it, which is there's going to be more software in the future than there was in the past. You can take that statement to the bank. And then another statement is there's always more risk and always new risk. And so I remember back in the days in the 80s, we spent all of our time and energy on market price risk, and we were barely becoming aware of counterparty credit risk, and liquidity and operational reputational risks were the next frontier. And then we really started worrying about cybersecurity risk as everything digitizes. And then we start worrying about market instability. And certainly there have been examples of flash crashes and other instabilities that go along with this digital journey. And well, the important thing is, are we learning from those risks, and are we learning to mitigate them? And so there were a whole number of flash crashes in a variety of markets, in dollar yen, in euro Swissy, in US equities, and UK equities, and we learned a lot from them. And certainly at Goldman Sachs, we got very, very disciplined about automated trading controls. Your colleague who works at Goldman will be learning all about ATRAC if she hasn't already heard about it, automatic trading controls. And that was very important risk mitigation. In fact, we shared it with the regulators and helpfully recommended that they require all of our competitor banks to have a similar framework. And so those risks have been mitigated. They could recur. They're unlikely to recur. I wish I could say we'd just be done, but we'll have other misadventures and we'll discover other kinds of problems. But I'm an optimist. So if you look at this pandemic and look at all the things that went wrong, there was one thing that shockingly didn't go wrong at all, that went almost perfectly right. Like the one part of the system that did have stresses and strains and problems, but they never rose to the level of public attention. And that was the banking system and the financial markets. And it really was the lessons learned of the financial crisis and the regulations introduced in the wake of it that mitigated those risks. And in fact, we found out the opposite lesson in the pandemic. Some of the central bank regulations introduced after the financial crisis, we argued were too onerous and didn't make any sense. Like here's one, the central banks decided that banks should hold equity capital against their cash on the balance sheet as a completely nonsensical thing, right? And indeed, that requirement was causing banks not to lend in the pandemic when they really needed to be lending. And so overnight, the Federal Reserve got rid of that constraint, which we'd said for years was a constraint that didn't make any sense. So that was an example of the regulations having been too tight and needing to be loosened up. But the banking system worked well, the markets worked well during the pandemic. And so I would say that is partial evidence that this risk mitigation is working, but it's imperfect and there will be other problems.